Before we begin, please be aware that the content of this presentation is for informational and educational purposes only. It is not intended to be a substitute for professional financial advice. The foreign exchange market involves substantial risk and is not suitable for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not indicative of future results. Please consult with a licensed financial advisor before making any investment decisions. Every single day, $7.5 trillion changes hands. That's not a typo. 7.5 trillion. That's more money than the New York Stock Exchange, the Tokyo Stock Exchange, and the London Stock Exchange trade combined. In a single day, this colossal river of money flows through a market that never sleeps, operating 24 hours a day, 5 days a week, across every time zone on the planet. And the craziest part? You've already been a part of it. If you've ever traveled to Canada or Mexico, or taken a trip to Europe, and you swapped your greenbacks for another currency at the airport kiosk, you've participated in the largest, most liquid financial market in the world, the foreign exchange market, Forex. But that simple transaction is just a ripple on the surface of a vast, deep ocean. And for the next few minutes, my goal is to give you a map of that ocean. We're going to strip away the confusing jargon and the intimidating charts you might see in movies. This is your foundational guide, built from the ground up specifically for a US perspective, to understand how this massive global engine actually works. By the end of this series, you won't just know what Forex is. You'll understand the economic forces that make the world go round. You'll see the news about international trade, interest rates, and global events not just as headlines, but as moves on a global chessboard, and you'll start to understand the hidden language of money itself. So what exactly is Forex? At its core, it's incredibly simple. Forget about stocks for a second. When you buy a share of Apple, you're buying a tiny piece of a company. You're betting on that company's success. Forex is different. You're not buying a piece of a company. You're buying a piece of a country's economy, in the form of its currency. You are exchanging one currency for another. Think of it like a giant, continuous tug-of-war between two countries. On one side, you have the United States dollar. On the other, you have the euro, or the Japanese yen, or the British pound. Traders are essentially placing bets on which country's economy they believe will be stronger. If you think the US economy is on a rocket ship and Europe's is slowing down, you might bet on the dollar getting stronger against the euro. If you believe Japan's export market is about to boom, you might bet on the yen. It's a direct comparison of economic health, political stability, and future outlook, all distilled into a single exchange rate. Now you might be thinking, okay, that's interesting for Wall Street types, but why should I, living in Ohio or Texas, care about the exchange rate between the euro and the dollar? The answer is, it affects almost everything you buy. That French wine you enjoy? The price is directly impacted by the euro to dollar exchange rate. That German car you're driving? Its sticker price in the US is a result of a Forex calculation. That smartphone in your hand with parts sourced from Korea, assembled in China, and designed in California? Its final cost is a symphony of currency exchanges. Even the price you pay for gas is influenced by Forex, because crude oil is priced globally in US dollars. When the dollar is strong, it means our purchasing power is high. We can buy more foreign goods for fewer dollars. When the dollar is weak, imported goods become more expensive for us, but it makes American-made products cheaper for the rest of the world to buy, which can be great for US exporters. So whether you know it or not, this global tug-of-war is happening in the background of your daily life, influencing the price of your coffee, your clothes, and your electronics. So who are the players in this $7.5 trillion a day game? It's not just individuals with a laptop. In fact, we retail traders are just small fish in a massive ocean. The real giants, the whales that move the market, are the major banks. We're talking about institutions like JP Morgan Chase, Citi, and Deutsche Bank. They're called the interbank market, and they trade huge volumes of currency with each other on behalf of their clients, and for themselves. These clients are massive multinational corporations. Think of a company like Nike. They make shoes in Vietnam, sell them in Europe, and report their profits back in the US. They have to constantly convert between Vietnamese dong, euros, and US dollars. To protect themselves from wild swings in currency values, they engage in massive Forex transactions. Then you have governments and central banks like our own Federal Reserve. They manage their country's foreign currency reserves and can intervene in the market to try and influence their currency's value to align with their economic policies. And finally, you have us, the retail traders, who are able to participate because of the technology and brokers that give us access to this incredible market. Now, in this market, currencies are always traded in pairs. You can't just buy dollars. You have to buy dollars with something else or sell dollars for something else. It's always a trade-off. This creates what we call a currency pair, like euro to US dollar. This is the most traded pair in the world, pitting the euro against the US dollar. The first currency in the pair, the euro, is called the base currency. The second one, the USD, is the quote currency. The price you see for euro to US dollar, let's say it's 1.08, is telling you how many units of the quote currency it takes to buy 1 unit of the base currency. So, in this case, it costs $1.08 to buy 1 euro. It's that simple. If you think the euro is going to get stronger against the dollar, you would buy the euro to US dollar pair. If you think the dollar will strengthen against the euro, you would sell the pair. The US dollar is the undisputed king of this market. It's on one side of nearly 90% of all Forex transactions. This is because it's the world's primary reserve currency. Most international trade, including for commodities like oil and gold, is conducted in US dollars. This creates a constant, massive global demand for our currency. Because of this, the most popular and heavily traded pairs almost always involve the greenback. You have the euro to US dollar, which we just discussed, often called fiber. Then there's US dollar to Japanese yen, the US dollar versus the Japanese yen, nicknamed the gopher. And you have pound sterling to US dollar, the British pound versus the US dollar, famously known as the cable, a historical nod to the transatlantic telegraph cable that used to transmit the exchange rate between London and New York. Understanding these major pairs is the starting point for understanding the entire market, because they represent the economic dance between the world's largest economic powers. We've just scratched the surface. We've defined what Forex is, why it matters to your everyday life, who the major players are, and how currencies are paired together. We've established that this isn't some abstract, far-off market. It's the fundamental operating system of the global economy, and the US dollar is right at its core. But this raises the most important question of all. If the price of a currency pair is just a reflection of a country's economic tug-of-war, what is actually pulling the rope? What are the real-world events and economic data points that cause the euro to surge or the dollar to stumble? To truly understand the market, we need to look under the hood at the engine that drives these movements. The interest rates set by central banks, the inflation reports, the employment numbers, and the geopolitical shocks that can send trillions of dollars flying across the globe in the blink of an eye. That is the real heart of the Forex market. And to understand that heart, we don't need to start with a Wall Street trading desk or a bank in London. We can start with something much more familiar. Imagine you're at JFK Airport in New York, getting ready to fly to London for a vacation. You walk up to a currency exchange kiosk. On the screen, you see two prices for the British pound or GBP. One says buy and the other says sell. Let's say the buy price is $1.30. That means for every 1 British pound you want to buy, you have to hand over $1.30 of your US dollars. Simple enough. You need 500 pounds for your trip, so you hand over $650, plus a small fee, and you get your crisp British banknotes. You have just participated in the Forex market. That's it. At its core, that is all Forex is, exchanging one currency for another. You sold your US dollars and you bought British pounds. Now fast forward a week. You've had a great trip, but you were more frugal than you thought. You have 100 pounds left over. You go back to the same kiosk at Heathrow Airport to change it back into dollars. You look at the screen, but something's different. The price to sell your pounds back to them isn't $1.30. It's $1.28. You exchange your 100 pounds and get back $128. But wait, if you had bought those pounds for $1.30 each, shouldn't you get $130 back? What happened to those 2 cents per pound? Where did that $2 go? That difference, that tiny gap between the buying price and the selling price, is called the spread. And it's the fundamental cost of doing business in the Forex market. The kiosk or the bank or the online broker, they make their money in that little gap. They buy a currency from you at a slightly lower price and sell it to someone else at a slightly higher price millions of times a day. Now, imagine that airport transaction magnified by a billion. Instead of you buying a few hundred pounds for a trip, it's a major US corporation needing to buy 100 million euros to pay for parts from a German factory. Or it's a Japanese pension fund wanting to sell billions of yen to buy US Treasury bonds because they offer a better return. Or it's a hedge fund in New York speculating that the Australian dollar is about to get stronger against the Canadian dollar. They aren't going to an airport kiosk. They're using massive electronic networks, trading directly with banks and other major institutions. But the principle is identical. They are buying one currency and selling another, and the prices are always quoted in pairs. This is the most crucial concept to grasp. In Forex, you never just buy the dollar or sell the pound. Currencies are only traded in pairs. It's like a seesaw. If one side goes up, the other must go down. When you trade the euro to US dollar pair, for example, you are simultaneously making a bet on the euro and the US dollar. If you buy the euro to US dollar, you are speculating that the euro will get stronger compared to the dollar. If you sell the euro to US dollar, you are speculating that the euro will weaken and the dollar will get stronger. Think of these pairs as the superstars of the financial world. There are hundreds of currencies, but a tiny handful get all the attention. These are called the majors. They're like the major league teams, the New York Yankees or the Dallas Cowboys of currency. They involve the US dollar paired with another major global currency. You have the euro to US dollar, the euro versus the US dollar. This is the king. It's the most traded financial instrument on the planet. More money moves through this single pair than almost any other market. Then you have US dollar to Japanese yen, the US dollar versus the Japanese yen. A battle between two economic titans. There's pound sterling to US dollar, the British pound versus the US dollar, often called the cable. And US dollar to Swiss franc, the US dollar versus the Swiss franc, seen as a safe haven currency. And of course, the commodity currencies, like the Australian dollar to US dollar, Australian dollar, and the US dollar to Canadian dollar, whose values are often influenced by the prices of natural resources like oil, gold, and iron ore. When you look at a quote for one of these pairs, say euro to US dollar is at 1.0800, what does that number actually mean? Simpler than it looks. The first currency in the pair, the euro in this case, is called the base currency. The second one, the USD, is the quote currency. The base currency is always equal to 1. The number 1.0800 is telling you how much of the quote currency it takes to buy 1 unit of the base currency. So euro to US dollar at 1.0800 means it costs $1.08 to buy 1 euro. That's it. If the number goes up to 1.0900, it now costs more dollars to buy a euro, which means the euro has gotten stronger or the dollar has gotten weaker. If the number goes down to 1.0700, the euro has weakened or the dollar has strengthened. Now, you might be thinking, a change from 1.0800 to 1.0801 is tiny. That's 1/100th of a cent. How could anyone possibly care about such a small movement? And you'd be right. It is a tiny movement. But in the world of Forex, that tiny movement has a name, and it is the single most important unit of measurement. It's called a pip, a percentage in point. For most currency pairs, a pip is the 4th decimal place. So, if euro to US dollar moves from 1.0800 to 1.0801, it has moved up by 1 pip. Why does this minuscule number matter? Because of leverage and volume. While the value of a pip is incredibly small, traders aren't just trading 1 euro at a time. They are trading in standardized amounts called lots. Think of it like buying eggs. You don't go to the supermarket and buy one single egg. You buy a dozen or maybe a flat of 30. It's a standard unit. In Forex, it's the same. The standard unit is a standard lot, which is 100,000 units of the base currency. So, if a trader buys one standard lot of euro to US dollar, they aren't controlling 1 euro. They are controlling 100,000 euros. Now that 1 pip move doesn't seem so small. On a standard lot, a 1 pip move is typically worth about $10. If the euro to US dollar moves up by 10 pips, a position of one standard lot could potentially increase in value by $100. If it moves 50 pips, that's $500. You can see how these tiny fractional movements, when applied to a large volume of currency, can translate into significant changes in value. Of course, this works both ways. A 50 pip move against your position could represent a $500 decrease in value. This is a fundamental aspect of how risk is managed in these markets. For beginners, trading a full standard lot can be a lot of exposure. That's why brokers also offer smaller lot sizes. There's the mini lot, which is 10,000 units of the base currency. Here, a 1 pip move is worth about $1. And there's the micro lot, which is 1,000 units, where a 1 pip move is worth about 10 cents. These smaller sizes allow individuals to engage with the market at a scale that is more aligned with their personal risk tolerance and account size. So let's put it all together. The giant 24-hour global Forex market is just millions of participants, from vacationers like us to the world's biggest banks, exchanging currencies in pairs. The price of these pairs, like euro to US dollar, tells us the relative strength of one currency against another. These prices move in tiny increments called pips, and traders participate by buying or selling standardized volumes of these pairs, called lots. The spread is the built-in cost of the transaction. The pair tells you which team you're betting on. The pip is how you keep score. And the lot size determines the stakes of the game. This is the basic machinery. These are the nuts and bolts. But knowing how the engine is built is one thing. Knowing what makes it run, what makes the euro suddenly surge or the yen take a nosedive, that's a different story. That takes us away from the mechanics and into the powerful forces that actually move these trillions of dollars every single day. We're talking about the economic heartbeat of nations. And that heartbeat isn't a steady, predictable rhythm. It's more like a complex drum solo with sudden bangs, quiet moments, and earth-shaking crescendos. The forces that move the Forex market are the very same forces that shape our daily lives, from the price of gas to the interest rate on our mortgage. It's a global heavyweight title fight, and every single economic news release is a punch thrown. So let's pull back the curtain on the two most powerful fighters in the ring, the two forces that, above all others, dictate the rise and fall of currencies. Think of them as the king and the dragon. The king in this story is a country's central bank. For the United States, this is the Federal Reserve, or the Fed, as you'll hear it called constantly. The Fed's job is to keep the U.S. economy stable and growing. It has many tools, but its most powerful weapon, its Excalibur, is the interest rate. Now, interest rate sounds like a boring term you'd hear in a stuffy bank meeting. But in the world of Forex, it is pure, unadulterated power. Imagine you have $100,000 to save. Bank A offers you 1% interest per year. Bank B, across the street, offers you 5% interest. Where are you putting your money? It's a no-brainer. You're going to Bank B to get that higher return. Now scale that up. Instead of you with $100,000, imagine it's a massive international investment fund with $10 billion. And instead of Bank A and Bank B, it's the United States and Japan. If the U.S. central bank, the Fed, raises its interest rates to 5%, while Japan's central bank keeps its rates near zero, where do you think that $10 billion is going to flow? It's going to flood into the United States. To invest in the U.S. and get that sweet 5% return, that fund has to convert its Japanese yen into U.S. dollars. And what happens when billions of dollars worth of yen is suddenly sold to buy billions of U.S. dollars? The demand for the U.S. dollar skyrockets and its value goes up. The U.S. dollar becomes stronger. The interest rate acts like a powerful magnet, pulling global capital towards it. Conversely, if the Fed cuts interest rates, that magnet weakens. Investors might look elsewhere for better returns, selling their US dollars to buy, say, Australian dollars or British pounds if those countries have higher rates. This increases the supply of US dollars on the market, potentially weakening its value. This is why every word from the chairman of the Federal Reserve is analyzed by traders with the intensity of bomb disposal experts. A single hint, a subtle change in tone about future interest rate policy can send shockwaves through the entire Forex market, causing currency pairs to swing wildly in a matter of seconds. The Fed is the king, and its interest rate decisions are its royal decrees that the entire financial world must obey. But what makes the king raise or lower his sword? What is he fighting? That brings us to the dragon. The dragon is inflation. Inflation is the silent thief that erodes the value of your money. It's the reason a candy bar that cost a quarter when your parents were kids now costs $2. It means your dollar today will buy you less stuff tomorrow. For an economy, a little bit of inflation is considered healthy, like a low-grade fever that shows the body is active. But when inflation gets too high, when it starts breathing fire, it becomes a destructive dragon, burning through people's savings and destabilizing the entire kingdom. A currency from a country with high, out-of-control inflation is like a melting ice cube. Nobody wants to hold it because they know it will be worth less and less over time. Global investors will flee that currency, selling it as fast as they can, causing its value to plummet. So the king, the central bank, has a mandate to slay the inflation dragon. And its primary weapon? You guessed it, raising interest rates. By making it more expensive to borrow money, the Fed can cool down the economy, slow down spending, and bring inflation back under control. It's a delicate, dangerous dance. Raise rates too much or too fast, and you might choke the economy into a recession. Do too little, and the inflation dragon runs rampant. This epic battle between the central bank and inflation is the central drama of the Forex market. Traders watch inflation data, like the Consumer Price Index or CPI, with hawk-like focus. When the CPI report is released in the US, it tells the market how hot the dragon's fire is burning. If inflation is higher than expected, traders will immediately start betting that the Fed will have to raise interest rates to fight it. And in anticipation of those higher rates, they start buying US dollars, pushing its value up, all within minutes of the news release. So we have the king, the Fed, and the dragon, inflation. But they aren't the only characters in this epic. There are other powerful forces at play, giving us a clearer picture of a nation's economic health. One of the most important is the gross domestic product, or GDP. Think of GDP as the country's quarterly report card. It's the total value of everything, every car, every coffee, every software subscription, produced in the country. A strong, growing GDP is like getting straight A's. It signals a robust, healthy economy. Businesses are thriving, people are working, and the future looks bright. This attracts foreign investment, which, as we know, strengthens the currency. A weak or shrinking GDP is a failing grade. It signals economic trouble, potentially scaring investors away and weakening the currency. Then there's the employment situation. This is the health check of the nation's workforce. In the United States, the most watched report is the Non-Farm Payroll, or NFP, released on the first Friday of every month. This report tells the market how many jobs were created or lost in the previous month. Why is this so critical? Because a country where more people are getting jobs is a country where more people have money to spend. More spending drives economic growth, which is good for the currency. A strong NFP report can send the US dollar soaring, while a weak report can cause it to stumble. It's considered one of the most volatile news releases, a monthly Super Bowl for Forex traders. So you see, it's not just one thing. It's a symphony of data points. A trader is like a detective, piecing together clues. They look at interest rates, inflation numbers, GDP growth, and employment data. They're trying to build a case for whether a country's economic heartbeat is getting stronger or weaker. And here's where it gets really complex and fascinating. These forces don't exist in a vacuum. They influence each other. For example, very strong employment numbers might be great news, but they could also lead to higher wages, which could then fuel the inflation dragon, forcing the Fed king to raise interest rates. One piece of good news can contain the seeds of a future problem. It's a constant puzzle. A trader isn't just asking, is the US economy strong? They're asking, is the US economy stronger relative to the European economy? Or, is Japan's economic policy likely to make the yen weaker than the Canadian dollar in the next 3 months? Understanding these fundamental forces, the central bank's inflation, GDP, employment, is like learning the rules of the game. It's the foundation upon which all trading strategies are built. It's how you move from simply looking at squiggly lines on a chart to understanding the powerful real-world stories those lines are telling. The story of a nation's struggle for stability, its fight for growth, and its place in the massive interconnected global economy. But this is only half the picture. Because even if you understand all the economic data perfectly, even if you know what the Fed is going to do next, there's another force at play. A force that is often irrational, emotional, and unpredictable. It's the collective psychology of millions of traders all acting at once. It's the fear and greed that can sometimes throw all the economic rulebooks out the window. And that takes us from the science of economics to the art of reading the market itself. So, if we want to understand these massive swings in value, we need to learn how to read the market. And in the world of trading, there are two major schools of thought on how to do this. Two completely different philosophies, almost like two rival detectives trying to solve the same case. One detective focuses on gathering external evidence, interviewing witnesses, and checking background reports. The other locks themselves in a room with just a single photograph of the crime scene, believing every clue they need is hidden within that image. In Forex, these two detectives are known as fundamental analysis and technical analysis. Let's start with the first one, the evidence-gathering detective. Fundamental analysis is the art of looking at the big picture. It's about understanding the economic, social, and political forces that drive a currency's value up or down. A fundamental analyst isn't staring at a price chart. They're reading the news. They're looking at a country's entire economic health report. They believe that if a country's economy is strong and growing, its currency will inevitably follow suit. So, what are they looking for in this report? They're tracking a few key vital signs. The first and arguably the most important is interest rates. Think about it from a personal perspective. If you have $100,000 to save, are you going to put it in a US bank offering 5% interest, or a bank in another country offering just 1%? You choose the US bank, of course. You get a better return. Large investment funds, corporations, and banks think the exact same way, but on a scale of billions. When the US Federal Reserve raises interest rates, it makes holding US dollars more attractive because you can earn more interest on them. This creates a huge demand for dollars from global investors, which in turn pushes the value of the dollar up. Conversely, when the Fed cuts rates, the dollar becomes less attractive, and its value tends to fall. So, traders who use fundamental analysis hang on every word from the Federal Reserve Chairman. The next big one is the Gross Domestic Product, or GDP. This is basically the country's economic report card. It measures the total value of all goods and services produced in the country. A strong, growing GDP number suggests a healthy, expanding economy. Companies are profitable, people have jobs, and they're spending money. This signals stability and strength, making that country's currency a more attractive asset to own. A weak or shrinking GDP, on the other hand, is a major red flag, often leading investors to sell that currency. Then there's inflation. We've all been feeling this one at the grocery store. Inflation is the rate at which the general level of prices for goods and services is rising, and subsequently purchasing power is falling. A little bit of inflation is considered healthy for an economy, but high inflation can be a problem. It erodes the value of a currency. Your dollar literally buys less than it used to. This can be a tricky one because sometimes to fight high inflation, the central bank will raise interest rates. And as we just learned, higher interest rates are good for a currency. This is where fundamental analysis becomes a puzzle, trying to figure out which force is stronger, the negative of inflation or the positive of a potential rate hike. And finally, a huge one for the US dollar is employment data. Specifically, a report that comes out on the first Friday of every month called the Non-Farm Payrolls, or NFP. This report tells the market how many jobs were added or lost in the US economy over the last month. Why does this matter so much? Because it's a direct snapshot of economic health. More people working means more people earning and spending, which drives economic growth. A strong jobs report is a powerful sign of a robust economy and usually sends the US dollar higher. A weak report can have the opposite effect. A fundamental analyst pieces all of this together, interest rates, GDP, inflation, employment, to build a story about a country's economy. They're trying to answer the question, based on all this evidence, should this currency be stronger or weaker in the future? Now let's look at our other detective, the one who ignores all the news, all the reports, and all the economic data. This is the technical analyst. Technical analysis is the study of price movement itself. The core philosophy here is that all of that fundamental information, every economic report, every news headline, every political event, is already factored into the current price you see on the screen. The chart, they believe, tells the whole story. They see the price movements not as random noise, but as a reflection of supply and demand, and the battle between buyers, known as bulls, and sellers, known as bears. To a technical analyst, history tends to repeat itself. Human psychology, that fear and greed we talked about, doesn't really change. Therefore, price patterns that have happened in the past are likely to happen again in the future. Their job is to identify these patterns on a chart to get clues about where the price might go next. It's like being a tracker in the woods. You're not concerned with why the animal is going north. You're just studying its footprints in the snow to predict its next move. So what tools do they use? Their primary tool is the price chart itself, often displayed with what are called candlesticks. Each candlestick represents a specific period of time, say 1 hour, and it tells a 4-part story. Where the price opened, where it closed, the highest point it reached, and the lowest point it reached within that hour. By looking at the shape and color of these candlesticks, traders try to gauge the momentum and sentiment of the market. A long green candle might show strong buying pressure, while a long red one could indicate intense selling. From there, they identify key concepts. One of the most basic is support and resistance. Imagine a tennis ball bouncing in a room. It bounces up from the floor and comes down from the ceiling. In trading, support is like that floor. It's a price level where a downtrend can be expected to pause due to a concentration of demand or buying interest. Buyers see the price as a bargain at that level and step in. Resistance is the ceiling. It's a price level where an uptrend can be expected to pause. as selling interest overcomes buying interest. These levels are created by the collective memory of the market. Technical analysts also focus heavily on trends. Is the price generally moving up over time, creating higher highs and higher lows? That's an uptrend. Is it generally moving down with lower lows and lower highs? That's a downtrend. Or is it just moving sideways in a range? The old saying in technical trading is, the trend is your friend. The idea is to identify the dominant trend and trade in that direction, rather than trying to fight against the market's momentum. Finally, they use what are called indicators. These are mathematical calculations based on a currency's price or volume, plotted on the chart. Things like moving averages, which smooth out price data to help identify the trend direction, or the relative strength index, RSI, which helps gauge if a currency is overbought or oversold. Think of indicators like the dashboard of a car. They don't drive the car, the price does, but they give you useful information, like your speed or your engine temperature, to help you make better driving decisions. So we have these two opposing views: the fundamental analyst who says the economy drives the price, and the technical analyst who says the price is all that matters. Who's right? Well, the truth is, most experienced traders find value in both. They're not mutually exclusive, they're two sides of the same coin. Fundamental analysis can tell you why a market should move, and technical analysis can help you determine when it might move. Think of it this way: fundamental analysis might tell you that, because the US economy is booming and the Fed is raising rates, the US dollar is likely to be a very strong currency for the next year. That gives you your long-term bias. But it doesn't tell you the best time to actually buy it. You could buy it today, only to see it drop for 2 straight weeks before starting its big climb. That's where technical analysis comes in. You can look at the chart of the US dollar and wait for the price to pull back to a key support level, or for a bullish candlestick pattern to appear. This potentially gives you a much better entry point for the trade that your fundamental analysis identified. The fundamentals give you the what to trade, and the technicals can help with the when to trade. Understanding these two great philosophies is the foundation of forming a market view. But knowing how to analyze the market is only one piece of the puzzle. To truly understand the game, you have to know who the other players are. Because you're not just trading against a chart on a screen, you're competing against everyone from individual traders like yourself to the colossal financial institutions that can move billions of dollars and the entire market with a single click. And understanding who these players are, what motivates them, and how much power they wield is one of the most critical, yet overlooked pieces of the puzzle for a new trader. Because when you place a trade, you're stepping into an ocean. And in this ocean, there are different classes of predators and prey. You need to know if you're a minnow swimming amongst whales. So let's break down the hierarchy of the Forex market. Think of it as a pyramid. At the very top, the capstone of this entire structure, you have the central banks. These are the big daddies of the financial world. For the United States, this is the Federal Reserve, or the Federal. For Europe, it's the European Central Bank. For Japan, the Bank of Japan. These institutions aren't in the game to make a profit like everyone else. Their job is completely different. They have mandates to control their country's money supply, manage inflation, and stabilize their economy. Their primary tool? Interest rates. When the Fed raises interest rates, it suddenly becomes more attractive for global investors to hold US dollars, because they can earn a higher return. This increased demand can cause the value of the dollar to rise against other currencies. Conversely, when they cut rates, the dollar might become less attractive and its value could fall. Central banks are like the gods of the Forex world, occasionally reaching down from Mount Olympus to change the weather. They don't trade day to day, but when they act or even just speak, they create tidal waves that everyone else has to react to. That's why a speech from the Fed chair can cause more market movement in 10 minutes than an entire week of normal trading. Their goal is stability, but their actions create the massive volatility that traders thrive on. They set the fundamental economic climate for their currency. Just below the central banks on our pyramid are the true giants, the blue whales of the ocean, the major commercial and investment banks. We're talking about names you know: JP Morgan Chase, Goldman Sachs, Deutsche Bank, Citigroup. This is the interbank market, and it's where the overwhelming majority of all Forex trading happens. We're talking trillions of dollars per day. These banks are the core of the market. They don't just trade for themselves, they trade on behalf of their massive clients, multinational corporations, huge investment funds, and even other smaller banks. If a US company like Apple needs to pay its suppliers in China, they need to convert billions of US dollars into Chinese yuan. They don't do this through a retail app. They go to a major bank. The bank facilitates this massive transaction, and in doing so directly influences the supply and demand for those currencies. These banks are connected to each other through sophisticated electronic networks, constantly quoting buy and sell prices for currencies. The price you see on your retail trading platform? It's derived from these interbank prices. They are the market makers. They create the liquidity, the ability to buy or sell easily, that the entire system relies on. Their sheer volume gives them an incredible advantage. They have access to information and order flows that retail traders can only dream of. They can see where huge buy and sell orders are sitting, giving them a map of the market's intentions. They are the house and they have a powerful edge. Next on the pyramid, swimming right alongside the whales, are the sharks. These are the large institutional investors, hedge funds, and portfolio managers. Unlike the big banks who have many different business lines, these players often have one primary objective: to generate massive returns for their investors through speculation. They are aggressive, sophisticated, and they command enormous pools of capital. They use complex strategies, high leverage, and detailed analysis to make big bets on currency movements. This is where you hear the legendary stories. Think of George Soros, the hedge fund manager famously known as the man who broke the Bank of England. In 1992, his fund took a massive short position against the British pound, betting that it was overvalued. He risked billions, and his conviction, along with other speculators who followed him, created so much selling pressure that the British government was forced to pull the pound from the European exchange rate mechanism. The pound's value plummeted, and Soros's fund reportedly walked away with over $1 billion in profit. That's the kind of power these funds can wield. They look for weaknesses, for mispriced currencies, and they attack with overwhelming force. They don't move the market on the scale of the entire interbank system, but they can certainly trigger dramatic, short-term volatility, and even influence the direction of a trend. They are the apex predators of this ecosystem. Now we move further down the pyramid. Here we find the multinational corporations. Companies like Coca-Cola, Microsoft, or Toyota. They aren't primarily speculators. They are in the Forex market out of necessity. If Toyota, a Japanese company, sells a car in the United States, they receive US dollars. But they need to pay their employees and suppliers back in Japan with Japanese yen. So, they have to constantly convert currencies to run their day-to-day business. Because they deal in such huge amounts, a small shift in an exchange rate can mean the difference of millions of dollars in profit. To protect themselves from this risk, they engage in what's called hedging. They use the Forex market to lock in an exchange rate for a future transaction. While their primary goal isn't to speculate, the sheer volume of their transactions adds significant liquidity and flow to the market. They are the functional, commercial backbone of daily Forex activity. Finally, at the very bottom of the pyramid we find us, the retail traders. We are the school of fish. Individually, our trades are a microscopic drop in the ocean. A retail trader putting on a standard lot of $100,000 is nothing compared to the billion-dollar transactions happening on the interbank market. We have the least amount of capital and the least amount of direct influence on the market. So how do we even participate? We can't just call up JP Morgan and ask to trade. We need a gateway and intermediary. And that's the role of the retail Forex broker. These brokers bundle together all the small trades from thousands of retail clients like us and then pass them on to their liquidity providers, which are typically the larger banks higher up the pyramid. They give us access to the market and the platforms we use to analyze charts and place trades. Now, understanding this hierarchy is not meant to discourage you. It's meant to empower you. Knowing that you're a small fish doesn't mean you're destined to be eaten. Small fish are agile. They can get in and out of positions quickly, something a massive hedge fund can't do without causing ripples. But it does mean you have to be smart. You cannot fight the tide created by the central banks. You cannot stand in the way of a whale-sized order from a commercial bank. Your job as a retail trader is not to move the market. Your job is to become an expert at reading the currents. It's about recognizing the footprints of the giants and trading in the direction of their momentum. When you see a currency pair starting a powerful trend, it's not because a bunch of retail traders decided to buy at the same time. It's because one or more of the giant players higher up the pyramid are making their move. The game for us is one of reaction and anticipation. It's about aligning our small trades with the immense force of the major players. So we have this vast, complex ecosystem of players, each with their own motives, their own power, and their own strategies. From the policy-driven central banks to the profit-hungry hedge funds, They are the ones carving the canyons and raising the mountains on the price charts you see. The question is, how do we, from our position at the bottom of the pyramid, figure out what they're doing? How do we analyze the market to even begin to predict which way these powerful currents are likely to flow? Well, there are two primary schools of thought, two major philosophies for analyzing the Forex market that every single trader, from the newcomer to the seasoned pro, must understand. They are the two pillars upon which all trading strategies are built. And mastering the basics of both is your first step from being a simple spectator to becoming a true market analyst. Let's start with the first pillar, fundamental analysis. At its core, fundamental analysis is the art and science of evaluating a currency's intrinsic value by examining the economic, social, and political forces that affect its supply and demand. If technical analysis, which we'll cover next, is about reading the chart, fundamental analysis is about reading the world. It's about asking the big question: why is a currency moving? What are the underlying drivers making it stronger or weaker? Think of it like this. Imagine you're considering investing in a company. You wouldn't just look at its stock price history, would you? You'd want to know about its profits, its leadership, its industry, its competition. You'd read its earnings reports. You'd be doing fundamental analysis on that company. In Forex, we do the same thing, but our company is an entire country. We're analyzing the economic health and stability of a nation to gauge the future strength of its currency. So what are the earnings reports for a country? They are a series of key economic indicators released on a regular schedule. These data points are like a nation's vital signs, and traders around the globe watch them with hawk-like intensity. Understanding the most important ones is non-negotiable. First, and arguably the most powerful driver of currency value, is interest rates. The interest rate set by a country's central bank, in the United States, this is the Federal Reserve or the Fed, is like a magnet for global capital. Imagine you have a large sum of money to save. Bank A offers you 1% interest, and Bank B offers you 5%. All else being equal, you're going to put your money in Bank B to get a higher return. International finance works on a similar principle. When the U.S. Federal Reserve raises interest rates, it means investors can earn a higher return on assets denominated in U.S. dollars, like government bonds. This increases the demand for U.S. dollars from foreign investors who need to buy them to invest in these higher-yielding assets. Higher demand typically leads to a stronger dollar. Conversely, when the Fed cuts interest rates, the U.S. dollar becomes less attractive, demand falls, and its value can weaken relative to other currencies. This is why every word from the Fed chairman is scrutinized, and every interest rate decision can send shockwaves through the Forex market. Next up is the gross domestic product, or GDP. This is the big one. GDP is the total value of all goods and services produced by a country over a specific time period. You can think of it as the ultimate report card for a country's economic health. A strong, growing GDP number indicates that the economy is expanding, businesses are thriving, and people are spending. This paints a picture of a healthy, robust economy, which tends to attract investment and strengthen the national currency. A shrinking GDP, on the other hand, signals a recession, causing investors to lose confidence and potentially sell off the currency, weakening its value. Then we have inflation. You hear this word all the time, but what does it actually mean for currency trading? Inflation is the rate at which the general level of prices for goods and services is rising, and subsequently purchasing power is falling. A little bit of inflation is considered healthy for an economy, but high inflation is a major problem. It erodes the value of a currency domestically. Central banks absolutely hate high inflation, and their primary weapon to fight it is, you guessed it, raising interest rates. So when an inflation report like the Consumer Price Index or CPI comes out higher than expected, traders often start betting that the central bank will raise interest rates in the near future to cool things down. This expectation of higher rates can paradoxically make the currency stronger in the short term, even though high inflation itself is a long-term negative. It's a classic case of the market trading on the reaction to the news, not just the news itself. Now let's talk about jobs. In the United States, the single most watched economic report is arguably the Non-Farm Payrolls or NFP report. Released on the first Friday of every month, it represents the total number of paid U.S. workers of any business, excluding general government employees, private household employees, and employees of nonprofit organizations. It's a massive snapshot of the country's employment situation. Why is it so important? Because a healthy economy creates jobs. When more people are working, they have more money to spend. More spending drives economic growth, which is reflected in a higher GDP. A strong NFP number suggests the US economy is humming along, which reinforces the case for a strong US dollar. A weak number can signal an economic slowdown and weaken the dollar. The NFP release day is famous for creating huge volatility in the markets, as traders all over the world react to the data within seconds. Beyond these giants, other indicators play a crucial role. Retail sales figures measure consumer spending, which is the engine of the US economy. Strong sales are a sign of consumer confidence and economic strength. Industrial production and manufacturing data give us insight into the health of the manufacturing sector. Consumer confidence surveys help gauge the public's mood about the economy. An optimistic public is more likely to spend money. But fundamental analysis isn't just about scheduled data releases. It's also about reacting to the unpredictable. Geopolitical events are a massive, often sudden, driver of currency movements. A major election can completely change a country's economic outlook. The signing of a new trade agreement can boost the currencies of the countries involved, while a trade war can damage them. Political instability, conflicts, or even natural disasters can cause investors to flee a currency in search of a safe haven currency, like the US dollar, the Swiss franc, or the Japanese yen. These events can't be penciled into a calendar, but a fundamental analyst must always be aware of the global landscape. The real skill of a fundamental analyst is not just knowing what these indicators are, but connecting the dots to build a narrative. They see a strong jobs report and think, okay, more people working means more potential consumer spending. Then, a strong retail sales report confirms this. They see rising inflation and conclude, this might force the central bank's hand to raise interest rates at their next meeting. It's like being an economic detective, piecing together clues to form a thesis about where a country's economy, and therefore its currency, is headed. However, it's crucial to understand that fundamental analysis is not a perfect science. Sometimes, the market's reaction to news is completely counterintuitive. A report might come out that looks very positive for the US dollar, yet the dollar falls. Why? It could be because the good news was already priced in. This means that traders had been expecting the good news for a while and had already bought the dollar in anticipation. When the news finally came out, it was no longer a surprise, and some traders decided to sell the news and take their profits. At other times, a different story in another part of the world might be more powerful. Strong US data could be completely overshadowed by a major political crisis in Europe, causing traders to focus on the euro to US dollar pair for reasons unrelated to US economic health. So fundamental analysis gives us the why, the deep underlying reasons for a currency's long-term strength or weakness. It's the story of a nation's economy, told through data points, news headlines, and central bank policies. It helps traders form a directional bias, a belief that the US dollar, for example, is likely to get stronger over the coming weeks or months. But it doesn't always tell you the when. It doesn't pinpoint the exact moment to buy or sell. For that, we need to turn to the second pillar of market analysis. This is where we leave the world of economic reports and geopolitical news and enter the world of charts, patterns, and price action. This is the realm of technical analysis. So what exactly is this realm? At its core, technical analysis is built on a few simple yet profound ideas. The first is that everything you need to know about a currency pair, the economic data, the news, the investor sentiment, the fear, the greed, is already reflected in its price. Technical analysts believe that the price chart tells the complete story. You don't need to read every headline from the Federal Reserve if you can learn to read the chart. The second idea is that price moves in trends. An object in motion tends to stay in motion, and the same principle is often applied to markets. A currency pair that is rising is more likely to continue rising than it is to suddenly reverse, and vice versa. The job of the technical analyst is to identify the current trend as early as possible and ride it. And the third and perhaps most important idea is that history tends to repeat itself. More accurately, human psychology repeats itself. The way people react to price movements, with excitement when it's going up, and with panic when it's going down, forms patterns. These patterns have been observed and cataloged for over 100 years. By learning to recognize these patterns on a chart, you can get a sense of the probable future direction of the price. Think of it like being a meteorologist. A weather forecaster looks at satellite images, pressure systems, and historical weather data. They see a particular cloud formation that, in the past, has led to a thunderstorm 80% of the time. They can't promise it will storm, but they can issue a forecast based on high probability. Technical analysis is the financial equivalent of weather forecasting. We're looking for patterns in the data that suggest a probable outcome. The primary tool for this is the price chart. It's our satellite map. On any chart, you have two axes. The horizontal axis, the x-axis, represents time. This could be minutes, hours, days, or even years. The vertical axis, the y-axis, represents price. So at its simplest, a chart is just a visual record of how a currency's price has changed over a specific period of time. Now there are a few ways to draw this picture. The most basic is a line chart. You've seen these a million times on the news. It's just a single line that connects the closing price from one period to the next. If you're looking at a daily chart of the euro versus the US dollar, the line connects the closing price on Monday to Tuesday to Wednesday and so on. It's clean, it's simple, and it's great for getting a quick big picture view of the overall trend. But it lacks detail. It doesn't tell you what happened during the day, only where the price ended up. To get more information, traders started using bar charts. A bar chart shows you 4 key pieces of information for each time period: the opening price, the highest price, the lowest price, and the closing price. It looks like a vertical line with a small horizontal tick on the left and another on the right. The top of the vertical line is the high of the period, the bottom is the low. The little tick on the left is the opening price, and the tick on the right is the closing price. It's a clever way to pack more data into the chart, but for many, it can still look a bit cluttered and difficult to read at a glance. This is what led the Japanese rice traders in the 18th century to develop what is now the most popular type of chart in the world, the candlestick chart. Candlesticks show the exact same 4 pieces of data, the open, high, low, and close, but they do it in a way that is incredibly visual and intuitive. It turns a chart from a series of data points into a story of a battle between buyers and sellers. Let's break down a single candlestick. Imagine a rectangle with a thin line coming out of the top and another thin line coming out of the bottom. The thick rectangular part is called the body. The thin lines are called the wicks or shadows. The body tells you about the opening and closing price. If the body is green, it means the price closed higher than it opened for that period. The bottom of the green body is the opening price, and the top of the body is the closing price. This is a bullish candle, representing a period where the buyers won the battle and pushed the price up. If the body is red, it's the opposite. The price closed lower than it opened. The top of the red body is the opening price, and the bottom is the closing price. This is a bearish candle, showing that the sellers were in control and pushed the price down. Now for the wicks. The wicks show the extremes. The very top of the upper wick shows the absolute highest price the currency reached during that period. The very bottom of the lower wick shows the absolute lowest price it hit. So, in one single glance at one candlestick, you can see the entire story of a trading period. Let's say we're looking at a single daily candle for the US dollar versus the Japanese yen. If we see a long green body with a small upper wick, it tells us a story. It says the buyers were in control almost the entire day. The price opened, the buyers pushed it way up, and it closed near its highest point for the day. That's a sign of strong buying pressure. Conversely, if we see a long red body with a tiny lower wick, it tells us the sellers dominated. The price opened, sellers immediately took control, pushed the price way down, and it closed near its low for the day. That's strong selling pressure. What if you see a candle with a very small body but very long wicks on both the top and bottom? That tells a story of indecision. The buyers and sellers fought a massive battle. The buyers pushed the price way up, creating the long upper wick. Then the sellers fought back and pushed it all the way down, creating the long lower wick. But in the end, neither side could win, and the price closed very close to where it opened. This candle screams uncertainty and a potential change in direction. This is the language of the market. Each candlestick is a word, and a series of candlesticks forms a sentence, telling you about the psychology of the market participants. And this story unfolds across different time frames. A trader can look at a 1-minute chart to see the battle happening tick by tick. They can then zoom out to an hourly chart to see the story of the day, and then zoom out further to a daily or weekly chart to understand the epic, long-term war between buyers and sellers. The patterns often look similar on all these different scales. By learning to read these candlestick stories, technical analysts start to see the landscape of the market. They start to see key areas on the chart where the price seems to react time and time again. This leads us to the most fundamental concept in all of technical analysis, the idea of support and resistance. Imagine throwing a tennis ball in a room. The floor stops the ball from falling further. That's support. The ceiling stops the ball from rising higher. That's resistance. In the Forex market, support and resistance are price levels where the buying or selling pressure is historically strong enough to reverse the price direction. Support is a price level below the current market price where buying interest is typically strong. Think of it as a floor. As the price falls towards this level, many traders see it as a bargain and start buying. This influx of buy orders can overwhelm the sell orders, causing the price to stop falling and bounce back up. It's like a line in the sand drawn by the buyers. Resistance is the opposite. It's a price level above the current market price where selling interest is strong. It's a ceiling. As the price rises towards this level, traders who bought at lower prices might start taking their profits by selling. Others might see it as overpriced and start selling short. This wave of selling can overpower the buying, causing the price to stop rising and turn back down. These levels are not random. They often occur at psychologically significant round numbers or at previous highs and lows. The market has a memory. If a currency pair struggled to break above 1.2000 in the past, traders will remember that. The next time the price approaches that level, they will be watching very closely, anticipating another struggle. That memory, that collective psychology, is what creates these powerful floors and ceilings on the chart. Identifying these levels is the first step in building a map of the market. It allows a trader to understand the potential boundaries of price movement. It helps answer critical questions like, where might a trend run out of steam? Where might a falling price find a footing and reverse? These levels of support and resistance form the building blocks for countless chart patterns and trading strategies. They are the foundation upon which almost all of technical analysis is built. And learning to draw these simple lines on a chart is the first major skill in moving from a market spectator to a market analyst. So let's start with the absolute basics. The trend line. At its core, a trend line is just a straight line drawn on a chart connecting two or more price points. But its simplicity is deceiving. This single line can help us visualize the direction and strength of a trend and identify potential areas where the market might turn. First, let's talk about an uptrend. An uptrend is characterized by a series of higher highs and higher lows. Think of it like walking up a staircase. Each step up is a higher high and each flat part of the step is a higher low. To draw an uptrend line, you simply connect at least two of the major low points, or swing lows, in the price action. You extend this line out to the right into the future. This line now acts as a dynamic level of support. What does that mean? It means that as the price continues its upward journey, it has a tendency to come back down, touch this trend line, and then bounce off it, continuing its move higher. Each touch of the trend line can be seen as a confirmation of the trend's strength. The more times the price respects the line, the more significant that trend line becomes in the eyes of other market participants. Now let's flip that for a downtrend. A downtrend is the opposite. A series of lower lows and lower highs. It's like walking down a staircase. To draw a downtrend line, you connect at least two of the major high points, or swing highs. Just like before, you extend this line out into the future. This line now acts as a dynamic level of resistance. As the price moves lower, it will often rally back up, touch this trend line, and then get pushed back down, continuing its descent. This line represents a ceiling that the price is struggling to break through. The key here is the angle of the line. A steep trend line suggests a strong, aggressive trend, but these can often be unsustainable. A shallower trend line, say at a 45-degree angle, often indicates a more stable and healthy trend that could last longer. But what happens when these lines don't hold? This is where things get really interesting. A break of a significant trend line is a major event on a chart. If an uptrend line that has been respected multiple times is suddenly broken, with the price closing decisively below it, it's a warning sign. It tells us that the buyers who were holding that line are losing control, and the sellers are starting to take over. This could signal a potential reversal of the trend, from up to down, or at least a period of sideways consolidation. The same is true for a downtrend line. If the price breaks out and closes above a long-standing downtrend line, it's a signal that the sellers are exhausted and buyers are stepping in with force, potentially starting a new uptrend. This is a fundamental piece of information. It's the market telling you that the underlying psychology has shifted. Now let's build on this. If you can draw one trend line, you can draw two. When you have a trend and you draw a trend line connecting the lows in an uptrend, you can often draw a parallel line connecting the highs. This creates what we call a channel. The price is now contained within these two parallel lines, bouncing between them as it moves up. This is an ascending channel. The lower line is the primary trend line acting as support, and the upper line, called the channel line, acts as a resistance area or a potential take-profit zone for buyers. Similarly, in a downtrend, you can draw your primary trend line connecting the highs, and then a parallel channel line connecting the lows. This creates a descending channel. The price bounces between this ceiling of resistance and floor of support as it grinds lower. Channels are incredibly useful because they don't just tell you the direction of the trend, they give you a visual representation of its volatility and range. So we've covered diagonal lines. But what about horizontal lines? These are arguably even more important. These are your classic support and resistance levels. Unlike a trend line which moves with the price, these are static, horizontal price levels that the market has struggled to break in the past. Support is a price level where buying pressure is historically strong enough to overcome selling pressure, causing the price to stop falling and turn back up. To find a support level, you look for areas on the chart where the price has fallen to but then bounced off at least twice. It's a price floor. Think about it psychologically. When the price drops to a certain level, buyers see it as a bargain and step in. The more times a level holds as support, the stronger it becomes. Resistance is the opposite. It's a price level where selling pressure is historically strong enough to overcome buying pressure, causing the price to stop rising and turn back down. It's a price ceiling. To find a resistance level, you look for areas where the price has risen to, but then been rejected from at least twice. The psychology here is that as the price reaches a certain point, sellers believe it's overvalued and start to sell, while buyers get hesitant. Now for one of the most elegant concepts in technical analysis, the role reversal. When a strong support level is finally broken, it doesn't just disappear. It often transforms. That old floor becomes the new ceiling. This is because the market has memory. The buyers who bought at that support level and are now losing money might be looking to sell if the price gets back to their entry point just to get out at break-even. At the same time, traders who missed the initial breakdown might see a rally back to that old support level as a new opportunity to sell. This combination of factors turns the old support level into a new, powerful resistance level. The same principle applies in reverse. When a strong resistance level is broken, that old ceiling often becomes the new floor. Buyers who were waiting for a breakout will now defend that level, seeing it as a new area of value. This is a critical concept to understand because it shows how past price action can influence future price movements. These levels of interest stay on the chart and continue to be relevant. So, how do we use this in a practical sense? A key skill is learning to spot confluence. Confluence is when multiple technical indicators or analytical tools line up to point to the same conclusion. For example, imagine the price of the euro to US dollar is in an ascending channel. It's currently pulling back towards the bottom of the channel, the primary uptrend line. As you look further to the left on your chart, you notice that this exact price level was also a major horizontal resistance level a few weeks ago, which has now, in theory, flipped to become support. You now have two powerful reasons to believe that this price level could be significant: the dynamic support of the trend line and the static support of the old resistance level. This confluence increases the probability, though never guarantees, that buyers might step in at that level. It's crucial to understand that these lines are not impenetrable walls. They are more like zones or areas of interest. The market is not a perfect machine. It's a messy collection of human emotions and decisions. You will see false breakouts, where the price briefly pokes through a level only to snap right back. This is often called a fakeout, and it's designed to trap inexperienced traders. That's why many traders wait for a confirmation, like a full candle closing beyond the line, or even a break and retest, where the price breaks a level and then comes back to touch it from the other side, confirming the role reversal before continuing on its way. Drawing these lines is part art, part science. There's no single correct way to draw a trend line. Two different analysts might draw them slightly differently. The goal is not to be perfect, but to identify the most obvious and respected levels that a majority of other market participants are likely watching. Because in the end, that's all these lines are, a visual representation of market psychology. They work because thousands of other traders around the world are looking at the exact same chart, drawing the exact same lines and making decisions based on them. It becomes a self-fulfilling prophecy. Mastering these simple lines, trend lines, channels, and horizontal support and resistance is the bedrock of technical analysis. It allows you to create a framework for the market's chaos, to identify areas of potential opportunity, and to define risk. Before you can understand complex chart patterns or sophisticated indicators, you must first understand the fundamental story being told by these simple lines on a chart. They are the language of the market, and in the next part, We'll learn how they combine to form recognizable patterns that can offer even deeper insights into the market's next potential move. These patterns are the market's body language. They are recurring shapes formed by price action that can hint at the ongoing psychological battle between buyers and sellers. Think of them not as magic signals, but as classic stories that play out over and over again. Some stories are about a trend taking a brief pause before continuing its journey, while others are about a trend running out of steam and preparing to turn around. By learning to recognize these stories, you can gain a deeper understanding of market sentiment and potentially identify higher probability scenarios. It's crucial to understand that no pattern works 100% of the time. They are tools for analysis, not crystal balls. Their power lies in helping you frame the market, to ask what if? What if this pattern plays out as it has historically? What would that look like? This framework is what helps traders move from reactive guessing to proactive planning. We can broadly categorize these patterns into two main groups: continuation patterns, which suggest a trend is likely to continue, and reversal patterns, which suggest a trend may be about to change direction. Let's start with continuation patterns. These are like a pit stop in a race. The main trend is powerful, but it needs to consolidate to catch its breath before resuming its course. The most common of these are flags and pennants. Imagine a currency pair has a very strong, sharp move upwards, a tall, straight flagpole. After this explosive move, the price will often consolidate sideways in a tight, slightly downward sloping channel. This little channel looks like a flag hanging off the pole. This flag represents a period of profit-taking and indecision, but the underlying pressure is still upwards. The classic interpretation is that when the price breaks out of the top of that flag channel, the original uptrend is likely to resume with similar force. A pennant is nearly identical, but instead of a rectangular channel, the consolidation period forms a small, symmetrical triangle, like a little pointed flag or a pennant. The psychology is the same: a brief pause before the next leg of the journey. Another major family of continuation patterns is triangles. There are three main types: ascending, descending, and symmetrical. An ascending triangle forms when there's a flat, horizontal resistance level at the top, but the lows are getting progressively higher. Picture a staircase being pushed up against a ceiling. This pattern tells a story of buyers becoming more and more aggressive. They are willing to buy at higher and higher prices, creating those higher lows. The sellers are holding firm at a certain price level, creating the flat top. Eventually, the buying pressure may become too strong, and the price could break through that ceiling of resistance, continuing the uptrend. A descending triangle is the mirror image. You have a flat support level at the bottom, but the highs are getting progressively lower. This looks like a ceiling pushing down on a floor. It shows sellers are becoming more aggressive, willing to sell at lower and lower prices, while buyers are holding the line at a specific support level. The story here is one of increasing selling pressure. If that floor of support finally breaks, it could signal a continuation of the downtrend. Finally, there's the symmetrical triangle, where both the highs are getting lower and the lows are getting higher. The price is coiling into a tighter and tighter point. This represents pure consolidation and indecision. Both buyers and sellers are digging in, but neither side has the upper hand yet. The market is winding up like a spring. The potential outcome is a powerful breakout, but unlike the other two triangles, a symmetrical one doesn't have an inherent directional bias. Traders often wait to see which way the price breaks, either above the top trend line or below the bottom one, before considering it a signal for the trend's future direction. Now let's talk about the other side of the coin: reversal patterns. These are the patterns that can signal a major shift in market direction, like a powerful tide turning. They often take longer to form than continuation patterns and can signify a more significant change in the underlying market psychology. Perhaps the most famous reversal pattern is the head and shoulders. This pattern, which signals a potential top and a shift from an uptrend to a downtrend, looks exactly like its name suggests. First, you have a rally to a peak, which forms the left shoulder. Then the price pulls back slightly before rallying again to an even higher peak, forming the head. After that, the price falls again but then makes one last, weaker rally to a peak that's lower than the head, creating the right shoulder. If you draw a line connecting the low points of the pullbacks between the shoulders and the head, you get what's called the neckline. The head and shoulders pattern is considered complete, and a potential reversal is signaled only when the price breaks down below this neckline. The story it tells is one of a trend losing momentum. The rally to the head was the final burst of optimism, but the failure of the right shoulder to make a new high shows that the buyers are exhausted, and sellers are beginning to take control. Of course, there's also the inverse head and shoulders, which is the exact opposite. It's a bottoming pattern that can signal a shift from a downtrend to an uptrend. It's flipped upside down with 3 troughs instead of 3 peaks, and the breakout occurs when the price moves up through the neckline. Another incredibly common pair of reversal patterns are double tops and double bottoms. A double top looks like the letter M. The price rallies to a high, pulls back, and then rallies again to roughly the same level as the first high, but fails to break through it. This failure to create a new high is a significant sign of weakness. It shows that there is a strong resistance level that buyers just can't seem to overcome. The pattern is confirmed when the price breaks below the low point of the pullback between the 2 tops. It suggests that the buying pressure has been exhausted and sellers are now in control. A double bottom is the W-shaped counterpart. It occurs at the end of a downtrend. The price falls to a low, bounces, falls back to the same low again, and finds strong support, failing to go any lower. This shows that selling pressure is drying up at that level. The reversal is confirmed when the price breaks above the high point of the bounce between the 2 bottoms, suggesting that buyers are now stepping in with force. Recognizing these patterns is a skill, but it's only half the battle. There are critical rules to remember. First, a pattern is not a pattern until it is complete. A potential head and shoulders is just a series of peaks until the neckline is decisively broken. A common trap for new traders is acting on a pattern before it's fully formed and confirmed. Patience is paramount. Second, context is everything. A pattern that forms on a weekly chart is generally considered far more significant than one that forms on a 5-minute chart. The longer the time frame, the more weight the pattern may carry. Finally, and this is the most important point, these patterns can and will fail. Sometimes a perfect-looking flag pattern will break out in the wrong direction. Sometimes a confirmed double bottom will suddenly collapse into a new low. That is the nature of a market driven by millions of people. These patterns are not a license to print money. They are a way to organize the chaos of the market into recognizable scenarios. They help you identify key levels of support and resistance and understand the narrative of the struggle between buyers and sellers. They provide a potential framework for building a trading idea, a hypothesis about what the market might do next. But a hypothesis is just the beginning. Having a potential setup is one thing, knowing exactly how you will manage it, where you might consider entering, where you would place a stop loss to protect your capital if you're wrong, and where you might take profits if you're right, that is the architecture of a true trading plan. These patterns give us a potential roadmap, but a map is useless without a destination and a set of rules for the journey. And that is what separates speculation from a methodical approach. Building a robust plan and above all managing your risk. This plan is your personal constitution as a trader. It's a set of rules you create in a calm, objective state of mind that you are sworn to follow when the market gets chaotic and your emotions are running high. So, what goes into this constitution? First, your entry and exit criteria. Based on your analysis, whether it's a moving average crossover, a support level holding firm, or a fundamental news release, you need to define with zero ambiguity what signal tells you to enter a trade. And just as importantly, what tells you to get out. This isn't a vague feeling. It's a specific, repeatable condition. I will enter a long position on euro to US dollar if the 50-day moving average crosses above the 200-day, and the RSI is below 70. That's a rule. I think it looks like it's going up is a gamble. The second, and arguably most critical component is your risk management protocol. This is where most aspiring traders fail. Before you ever click the buy or sell button, you must answer 2 questions. Where will I get out if I'm wrong? And where will I get out if I'm right? The answer to the first question is your stop loss order. This is a preset order that automatically closes your position if the price moves against you by a certain amount. It's your safety net, the emergency brake that prevents a single bad trade from wiping out your account. The answer to the second question is your take profit order. This automatically closes your position when it reaches a certain level of profit, locking in your gains before the market has a chance to reverse. By setting these 2 levels before you even enter the trade, you define your risk. This leads to the all-important concept of the risk-to-reward ratio. Let's say you're willing to risk 20 pips on a trade to potentially make 60 pips. Your risk-to-reward ratio is 1 to 3. This is a powerful metric. It means you could be wrong 2/3 of the time and still potentially break even. Successful trading isn't about being right every time. It's about making more on your winning trades than you lose on your losing ones. A favorable risk-to-reward ratio is a cornerstone of that approach. Then there's position sizing. How much of your capital do you put on the line for any single trade? A common guideline in the industry is the 1% rule. This suggests that you should never risk more than 1% of your total trading account on a single trade. If you have a $10,000 account, your maximum potential loss on any given trade, as defined by your stop loss, should be no more than $100. This might sound small, but it's what allows you to survive. It means you could endure a string of 10, even 20 consecutive losses and still have the vast majority of your capital intact, ready to trade another day. It forces discipline and prevents the kind of catastrophic loss that ends careers before they even begin. But even with the perfect plan, the perfect strategy, and the perfect risk management, there's one final frontier you have to conquer: your own mind. Trading is one of the most psychologically demanding endeavors on the planet. It's a relentless battle against two of the most powerful human emotions: greed and fear. Fear causes you to close winning trades too early, grabbing a tiny profit because you're scared of it turning into a loss. It causes you to hesitate on a perfect setup, only to watch it take off without you. Greed, on the other hand, is just as destructive. It's the voice that tells you to move your stop-loss further away when a trade goes against you, convinced it will turn around. It's what makes you hold on to a losing position, praying it comes back to break even, while the loss gets bigger and bigger. This is called revenge trading. Jumping right back into the market after a loss to try and win it back, almost always leading to bigger, more emotional mistakes. The only antidote to this emotional roller coaster is unwavering discipline. Your trading plan is your anchor in the storm. Your job is not to predict the future. Your job is to execute your plan flawlessly over and over again. If your plan says to exit, you exit. No hesitation, no second guessing. If your plan says to stay out of the market, you stay out even if you feel the urge to do something. The market will always be there tomorrow. The question is, will you? And that comes down to your discipline today. So, after this entire journey from what a pip is to the psychology of the market, what is your very next step? It is not to open a live account and deposit your hard-earned money. Absolutely not. Your first step for weeks or even months is to open a demo account. This is a trading account with virtual money. It's your flight simulator. You get to use the real platform, see live price feeds, and place trades based on your strategy, but without risking a single dollar. This is where you test your trading plan. Does it work? Do you have the discipline to follow it? You can make all the beginner mistakes, feel the emotional pull of a trade, and learn the mechanics of your platform, all in a completely safe environment. There is no substitute for this experience. Once you have achieved consistent results in a demo account for a significant period, only then should you consider looking for a broker. For traders in the United States, this is a critical choice. The Forex market is regulated here by the Commodity Futures Trading Commission, or CFTC, and the National Futures Association, or NFA. You must ensure any broker you consider is registered with and regulated by these bodies. This provides a layer of protection and oversight. Look at their fee structures. Do they charge a commission? Or do they make money on the spread? Compare their spreads on the currency pairs you plan to trade. Test their trading platform and their customer service. A good broker is a partner in your trading journey. A bad one can be a significant obstacle. And finally, commit to being a lifelong student of the market. This series was designed to give you a solid foundation, a map of the territory. But the territory is always changing. Economic policies shift, new technologies emerge, and global dynamics evolve. Read books by seasoned traders. Follow reputable financial news sources. Stay curious. The moment you think you know it all is the moment you become most vulnerable. We started this journey with a simple question: what is Forex? And we've discovered it is so much more than just charts and pips. It's a reflection of the global economy, a massive interconnected system of capital and information. And learning to trade it isn't a get-rich-quick scheme. It's a pursuit that demands analysis, strategy, risk management, and above all, a mastery of your own psychology. The potential rewards are not just financial. They are the development of discipline, patience, and a profound understanding of how the world works. The path is challenging, but for those who approach it with respect, education, and a steadfast commitment to a well-thought-out plan, it is a journey worth taking. Thank you for joining us. Now the real work begins.